Okay, so you want to own a greenhouse. Glass walls, perfect climate, fresh vegetables growing year-round while the snow falls outside. No droughts, no floods, no waiting for the right season. Just controlled environment agriculture. The future of farming, they call it. A business where technology replaces weather, where yield is predictable, where a grocery store chain signs a contract to buy everything you grow before you've planted a single seed. That's the pitch. That's what the venture capital decks looked like in 2019 and 2020, when billions of dollars flooded into indoor agriculture faster than tomatoes could ripen. Here's what happened next. AppHarvest, a Kentucky-based greenhouse company backed by celebrity investors, featured on the cover of national business magazines, celebrated as the future of American agriculture. They raised over $700 million. They built a greenhouse facility the size of 60 football fields. They went public on the NASDAQ, and in July of 2023, they filed for Chapter 11 bankruptcy protection. The stock that once traded above $40 per share closed its final day on the public markets at $0.34. At the exact same moment AppHarvest was collapsing, a 12-acre family-owned greenhouse operation in West Michigan was quietly generating $3.2 million in annual profit. Same crop, same general market, completely different outcome. The difference between those two stories is not luck. It is not location. It is not even scale. It is the economics of this business. And the economics of greenhouse farming are among the most counterintuitive, most capital-intensive, and most misunderstood in all of American agriculture. That's what we're going to take apart today. Every layer, every cost, every hand in the pot. And by the end, you're going to understand exactly why a $500 million company went bankrupt growing tomatoes, while a family operation down the road is getting rich doing the same thing. Before you spend a dollar, you need to understand something that most people getting into this business figure out too late. Greenhouse is not one business. It is four completely different businesses sharing the same glass walls. The first is the small-scale local greenhouse. 3 to 5 acres of covered growing space selling directly to farmers markets, local grocery chains, and restaurant accounts. Low overhead, high margin per unit, deeply personal customer relationships. The ceiling on revenue is real, but so is the floor. This model has existed profitably for generations. The second is the regional mid-scale operation, 10 to 50 acres of controlled environment production, supplying regional grocery distributors, food service companies, and institutional buyers like hospital systems and university dining programs. This is where the serious money starts and where the serious risk begins. Capital requirements jump dramatically. Operational complexity multiplies, and the competition shifts from other small local growers to regional players with infrastructure you haven't built yet. The third is the large-scale commercial greenhouse, 50 acres and above, supplying national retail chains directly: Walmart, Kroger, Whole Foods. These buyers want volume, consistency, year-round supply, and prices that only the most operationally efficient producers can sustain. This is the model that attracted the venture capital. This is the model that produced the bankruptcies. The fourth is the specialty niche greenhouse. Microgreens, exotic herbs, edible flowers, hydroponic lettuce systems supplying premium restaurants and direct-to-consumer subscription boxes. Smaller footprint, dramatically higher price per pound, and a customer base that is less price sensitive than the retail grocery buyer who is always pushing your price down. Each of these is a fundamentally different financial model, and picking the wrong one for your capital level, your market, and your operational capability is the single most common mistake in this industry. This is where most business plans break. A basic unheated hoop house, the kind you see at small farm operations, a plastic-covered steel frame with no climate control, runs $2 to $5 per square foot to construct. On 1 acre of growing space, roughly 43,000 square feet, that's $86,000 to $215,000. Cheap enough that a serious small farmer can self-finance it. But an unheated hoop house is not a year-round production facility in most of the United States. It extends your season. It doesn't replace it. A proper commercial greenhouse with polycarbonate or glass glazing, baseline heating and ventilation, and a concrete perimeter foundation runs $10 to $25 per square foot to construct. 1 acre of this type of structure costs $435,000 to $1.1 million. For a serious regional operation targeting 10 acres of covered production, you're looking at $4.3 million to $10.8 million in structure costs alone before a single growing system is installed. A high-tech, controlled environment agriculture facility, the kind with automated climate systems, CO2 supplementation, LED grow lighting, hydroponic or aeroponic growing systems, and the sensor network that monitors every variable in real time, runs $30 to $75 per square foot for the full system. On 10 acres of growing space, that is $13 million to $32.5 million. App Harvest's flagship facility in Moorhead, Kentucky, covered 60 acres of growing space. At industry-standard construction costs for a facility of that specification, the build cost was consistent with their reported capital expenditure of over $200 million for the structure and growing systems alone. The land underneath all of this costs money too. Unlike an urban restaurant that needs a few thousand square feet, a commercial greenhouse operation needs acreage. An acreage with specific characteristics. Flat terrain for uniform drainage. Southern exposure for maximum natural light. Proximity to a highway corridor for efficient distribution. Access to significant water supply. And ideally, proximity to natural gas infrastructure. Because heating a greenhouse through a northern winter on propane or electric resistance heating is a cost structure that can make the entire operation unviable, regardless of what price your tomatoes bring. Agricultural land suitable for greenhouse development in the Midwest and Mid-Atlantic states ran $5,000 to $12,000 per acre in 2025, according to USDA land value data. A 50-acre parcel, enough land for 20 to 30 acres of covered growing space, with room for infrastructure, parking, and buffer, costs $250,000 to $600,000 before a foundation is poured. Total capital requirement for a serious regional greenhouse operation targeting 10 acres of production, $15 million to $35 million. And here is the detail that the venture capital pitch decks consistently underweighted. That capital is almost entirely illiquid. The greenhouse structure has limited salvage value if the business fails. The growing systems are highly specialized and difficult to repurpose. The concrete infrastructure reverts to the land. When App Harvest assets were liquidated in bankruptcy, the facilities that cost hundreds of millions to build sold for a fraction of that value because the buyer universe for a 60-acre tomato greenhouse in rural Kentucky is not large. Energy is the heartbeat of a commercial greenhouse. And in 2025 and 2026, energy is also the line item that is breaking greenhouse operations that the construction budget never anticipated. A commercial greenhouse in a northern climate, Ohio, Michigan, Pennsylvania, New York, requires continuous heating from October through April. Natural gas is the most economical heating fuel for large greenhouse operations, and a 10-acre facility burning natural gas for winter heating consumes approximately 50,000 to 120,000 decatherms of natural gas per year, depending on the climate zone and the growing temperature targets. At 2025, natural gas prices averaging $3.50 to $4.50 per decatherm for commercial buyers, annual heating costs for a 10-acre northern greenhouse run $175,000 to $540,000 per year just for heat. Add electricity. Supplemental LED lighting to extend the photo period during short winter days, essential for year-round production of fruiting crops like tomatoes and cucumbers. Runs high electrical loads continuously. Climate control systems, circulation fans, irrigation pumps, and the building management systems that monitor everything add more. A 10-acre high-tech greenhouse operation consumes 8 million to 15 million kilowatt-hours of electricity annually. At the average 2025 commercial electricity rate of $0.12 per kilowatt-hour across major greenhouse-producing states, That is $960,000 to $1.8 million per year in electricity costs alone. Combined energy costs for a 10-acre operation, $1.1 million to $2.3 million per year. This is the number that destroyed AppHarvest's financial model faster than any other single factor. Their facility was designed around natural gas pricing assumptions from 2019 and 2020. When energy prices spiked in 2021 and 2022, their operating costs exploded in a way their revenue could not absorb. They were locked into retail grocery supply contracts at prices negotiated before the energy crisis, and they could not raise those prices fast enough or far enough to cover the difference. Water is the second major operating cost, and one that is becoming increasingly significant as municipal water costs rise and environmental regulations around agricultural water use tighten. A 10-acre hydroponic greenhouse operation uses approximately 20 million to 40 million gallons of water per year. Most serious commercial operations use recirculating systems that capture and reuse runoff, dramatically reducing consumption. But the infrastructure for those recirculation systems adds $500,000 to $2 million to the initial build cost. Labor is the third major operating cost and the one that carries the most day-to-day complexity. Greenhouse production is not fully automated even in the most technologically advanced facilities. Tomatoes and cucumbers require hand pruning, training, and harvesting. Transplanting operations require skilled labor. Pest scouting, the daily inspection of plants for early signs of insect or disease pressure, requires trained eyes that no sensor system has yet fully replaced. A 10-acre commercial greenhouse operation employs 40 to 80 full-time workers, depending on the crop and the automation level. At 2026, agricultural labor wages ranging from $16 to $22 per hour in major growing states, annual labor cost runs $1.3 million to $3.6 million. Many greenhouse operations in northern states rely on the H-2A, Temporary Agricultural Worker Visa program, which adds administrative cost, mandatory housing provision for workers, and transportation cost that can add $3,000 to $5,000 per worker per season on top of the wage cost. Stack it all together. Energy, $1.7 million. Water and irrigation, $200,000. Labor, $2.5 million. Pest management and growing inputs, $400,000. Packaging and post-harvest handling, $350,000. Equipment maintenance, $300,000. Administrative and sales costs, $400,000. Total annual operating expenses for a 10-acre commercial greenhouse, $5.85 million to $8 million, depending on energy costs, labor market, and crop mix. A commercial greenhouse growing tomatoes, cucumbers, or peppers for retail grocery sells its product in one of three ways. Each one produces dramatically different economics. Direct retail supply, selling directly to grocery chains under a supply agreement, generates the highest volume but the lowest price per pound. Retail grocery buyers are among the most price-aggressive purchasers in the food industry. A conventional beefsteak tomato selling for $2.49 per pound at the retail shelf might generate $0.65 to $0.85 per pound at the wholesale price the greenhouse receives. The retailer takes the margin. The greenhouse takes the volume risk. A 10-acre tomato greenhouse producing at commercial yield rates generates approximately 15 to 25 pounds of tomatoes per square foot per year in a properly managed operation. On 435,000 square feet of growing space, that is 6.5 million to 10.9 million pounds of tomatoes annually. At $0.75 per pound wholesale, that is $4.9 million to $8.2 million in annual gross revenue. Against operating costs of $5.85 million to $8 million, the math is razor thin. In a bad energy year or a bad labor year, it is negative. Food service and institutional supply, selling to restaurant distributors, hospital systems, and university dining programs, generates $0.90 to $1.40 per pound for comparable product. The volume per account is lower than retail grocery, but the price premium is meaningful, and the buyers are less aggressive on price negotiation because consistency and reliability matter more to a hospital food service director than squeezing an extra 2 cents per pound. Direct-to-consumer and premium retail, selling at farmers markets through a CSA subscription model or to independent specialty grocery retailers, generates $2.50 to $4.00 per pound for greenhouse tomatoes, marketed on their local and sustainable credentials. The volume ceiling is real. You cannot move 10 million pounds of tomatoes through farmers markets, but the margin on every pound you do sell is transformative. This is the detail that explains why the West Michigan family greenhouse, generating $3.2 million in annual profit, exists in the same market where AppHarvest went bankrupt. The family operation sells 60% of its volume through premium retail and direct-to-consumer channels, at an average of $2.80 per pound. The remaining 40% goes to regional food service at $1.10 per pound. Their blended average price per pound is approximately $2.12. AppHarvest sold almost entirely to national retail grocery at prices that average below $1.00 per pound, because that was the only channel capable of absorbing the volume a 60-acre facility produces. Scale forced AppHarvest into the lowest margin channel in the market. The family operation's smaller footprint allowed it to stay in the highest margin channels. The family makes more money per pound. AppHarvest made more pounds. But pounds don't pay the bills. Margin does. Between 2018 and 2022, venture capital and private equity invested over $4 billion into controlled environment agriculture companies in the United States, according to PitchBook data. The pitch was compelling. Climate change is making outdoor agriculture unreliable. Consumers want local food. Technology can make indoor growing cost-competitive with field production. Almost none of those investments produced the returns the models projected. AppHarvest filed for bankruptcy in 2023. AeroFarms, a vertical farming company backed by Goldman Sachs and IKEA's investment arm, filed for bankruptcy in June 2023, with $200 million in liabilities. Bowery Farming, once valued at $2.3 billion, shut down all operations in May 2023 after raising $647 million in venture funding. Fifth Season, a Pittsburgh-based vertical farming company, closed in 2022 after raising $35 million. The pattern across every one of these failures is identical. Investor capital funded construction of facilities designed for a scale of production that the available market channels could not absorb at margins sufficient to cover operating costs. Energy costs were underestimated in the business model. Labor costs were underestimated. And the timeline to profitability was dramatically longer than the investor presentation suggested. The surviving commercial greenhouse operations share a set of characteristics that the failed venture-backed companies almost universally lacked. They started small and expanded incrementally, using cash flow rather than investor capital. They built their customer base before they built their growing capacity. They maintained multiple revenue channels rather than depending on a single retail grocery contract. And they chose their energy infrastructure with the same care they chose their growing systems. Because in this business, your energy bill and your crop price determine your survival, and only one of those is in your control. If you're finding this breakdown valuable, subscribe right now. We publish one of these every single week. Businesses that look simple from the outside and reveal something completely unexpected on the inside. Leave a comment below telling us what you want us to cover next. We read all of them. The controlled environment agriculture market in 2026 looks fundamentally different from the venture capital boom of 2019 to 2022. The U.S. indoor farming market was valued at $6.4 billion in 2024 and is projected to reach $9.1 billion by 2029, according to Markets and Markets Research. But the growth is concentrated in specific segments and specific operational models, not the large-scale commodity production that attracted and then destroyed the venture capital. Leafy greens and herbs have emerged as the most economically viable crops for controlled environment production. Lettuce, spinach, basil, and similar crops have short production cycles of 30 to 45 days, high turns per year, and price points that support the operating costs of indoor production without requiring the massive volume of a commodity tomato operation. A 1-acre hydroponic lettuce operation can generate $800,000 to $1.4 million in annual revenue at premium retail pricing, with operating costs that a properly capitalized small operator can manage. The local premium is real and growing. According to the USDA's 2025 Local Food Marketing Practices Survey, consumers paid an average premium of 22% for produce marketed as locally grown compared to conventional equivalents. For a greenhouse operator within 200 miles of a major metropolitan area, that premium is the difference between viable and unviable unit economics. Energy strategy is now the defining operational decision. Greenhouse operators in 2026 who are achieving sustainable profitability have universally addressed their energy cost structure before scaling their growing capacity. Co-location with biogas digesters that convert agricultural waste to methane for greenhouse heating. Power purchase agreements with solar developers that lock in electricity costs for 15 to 20 years. Geothermal heating in regions where subsurface temperatures support it. The operators who solved the energy equation first scaled second. The ones who scaled first and hoped to solve energy later are the ones who appear in the bankruptcy filings. Here is what the business actually looks like across the full range of outcomes in 2026. A small-scale premium greenhouse, 2 to 3 acres, selling through direct-to-consumer and premium retail channels, generates $400,000 to $900,000 in annual revenue with net margins of 18 to 28% in a well-run operation. Net income of $72,000 to $252,000 on an investment of $800,000 to $2 million. Cash-on-cash return of 9 to 18%. Modest but sustainable and buildable over time. A mid-scale regional operation, 8 to 12 acres, with a diversified channel mix weighted toward food service and premium retail, generates $3 million to $6 million in annual revenue with net margins of 10 to 18% when energy costs are properly managed. Net income of $300,000 to $1.08 million on an investment of $12 million to $25 million. This is the model that the West Michigan family operation represents. Achievable, requiring serious capital and serious operational discipline. A large-scale commodity operation, 30 acres and above, supplying national retail grocery exclusively, generates $8 million to $18 million in annual revenue with net margins that range from -5% in a bad energy year to +6% in an exceptional year. The AppHarvest model, high revenue, catastrophic downside. Almost no margin for error in a business where energy prices, labor markets, and retail buyer behavior are all outside your control simultaneously. Here is the honest answer. A greenhouse is not a bad business. It is a misunderstood business that has been oversold by venture capital to people who built for scale before they built for margin, and who signed retail grocery contracts before they solved their energy cost structure. The demand for locally grown, year-round fresh produce in the United States is real and growing. The climate disruption making outdoor agriculture less predictable is real and accelerating. The technology that makes controlled environment production more energy efficient every year is real and improving. None of those tailwinds went away when AppHarvest filed for bankruptcy. What went away was the illusion that you could skip the hard parts, that you could build at venture capital scale before proving the unit economics at family farm scale, that you could sign a Walmart supply contract before you understood what your tomatoes actually cost to grow in February. The greenhouse operators building real wealth in 2026 started with 2 acres in a farmer's market account. They expanded to 5 acres when the farmer's market account was profitable. They added a food service customer when the 5-acre operation was cash flow positive. They solved their energy costs before they broke ground on the next expansion. They treated scale as a reward for getting the economics right, not as the strategy for making the economics work. The glass walls were never really the product, the controlled environment inside them, The ability to grow a perfect tomato in January in Ohio and sell it at a price that covers every cost and still leave something for the person who built the house around it, that is the product. And the operators who figured out the cost of that controlled environment before they built it are the ones still growing.